world. And thank you so much for joining us on another edition, another very interesting, engaging installment of Leading Conversations with FBN Quest, the fantastic people at FBN Quest. My name is Aruture Udiri, or Rutus, actually, Rutus Udiri. I host the Global Business Report on Arise TV, also Business Express on 98.1 FM. I am very, very happy to be with you all again. Hope you're keeping safe. Also, thank you so much for taking the time to join us for this very engaging conversation that we're about to have with the good folks at FBN Quest. Just to give you a brief background while our attendants are all getting situated and getting together. Leading Conversations with FBN Quest is a webinar series, and it's created to bring you market, industry, consumer insights, and analysis that are crucial for individuals and corporate success, because whether you're an individual or a corporation, success is always on your mind. Now, the series, it features leading professionals of FBN Quest, as well as other industry experts with experience in corporate, private investment management, wealth preservation, financial advisory, and other areas of interest. So we hope to open your mind into a world of opportunities through these sessions. And we very much look forward to engaging with you. This, I believe, is the third one in honor of Women's Month. So I'm going to introduce the two experts that are joining us today and are going to be answering your questions. Speaking of your questions, there's a Q&A box at the bottom, and we're going to be having you all sending your questions. Laura Fisayo Kolawole, start with her first. She's the head of equities and alternative assets portfolio management at FBN Quest Asset Management. She's responsible for the investment strategy and solutions development within the multi-asset portfolio management team, leading a diverse team of portfolio managers and product developers. Laura specialized in UK equities, working within the team responsible for managing the UK equity portfolio for the investment management client funds. Laura is also part of a team that executed global multi-asset portfolios with almost $1.5 billion in assets under management. So once again, that's Laura Fisayo Kolawole. Our other awesome guest joining us, analyst also with FBN Quest, is Tutu Owolabi Kadilo. And Tutu is a member of the fixed income portfolio management team at FBN Quest. Prior to specializing as a portfolio manager, Tutu worked as a fixed income trade and fixed income investment analyst with assets under management of over 100 billion naira. Now, Tutu is a chartered alternative investment analyst, CAIA, chartered financial analyst, CFA holder, an active member of the CFA Nigeria Society, and she holds the CFA Institute Certificate in Investment Management. She's also knowledgeable in areas of Islamic finance and holds a certified Islamic finance executive qualification. Tutu has extensive expertise in fixed income trading with key competencies in asset and liability management, portfolio construction, and management. So as you can see, we're stacked. FBN Quest is stacked with analysts. So we're going to proceed with a number of questions about investments. When it comes to investments, rather, portfolio diversification, diversifying your investments. But before we begin, before I ask our first question, we have polls, all right? We're going to have a number of polls. We want to get the pulse of you, our participants in this webinar. So we've got a number of questions, and we want you to be able to answer these polls because it's going to be part of our conversation. We've got about 3 of them. So there's the first question. There it is. How diversified are your investments? It's the first option. Are you diversified? You have 3 or more investment types. Or is it option B? Yeah, you're somewhat diversified. You got 2 investments. And then the third one, diversified, what are you talking about? All my money is saved on one platform. So go ahead and vote. Vote right now. Vote right now. We'll share the results, and then we're going to add that to our conversation. So as we talk about that diversifying, Laura, I'm going to start with you. Again, Laura Fisayo Kolawole. How would you describe, Laura, a well-diversified or well-balanced investment, and why is it important to have one? The floor is yours.
All right, thank you, Rosus, and good afternoon, everyone, and thank you for joining us today. Now, when I think about diversification to start with, for me, it's really about investing in many different types of securities the reason you're doing that is to reduce how sensitive your portfolio or your investments are to the risk of any one investment within your portfolio. Now, the main reason you'll be doing that is to reduce the effect of large losses in any investment on the whole portfolio value. So when you think about diversifying, it's really about risk management. And it's based on the belief that holding different types of investments, within your portfolio yields a potentially higher return, but more importantly, poses a lower risk than any one investment within the portfolio. So like I said, it's really around risk management. Now, to my mind, an excellent way to diversify your portfolio is to use mutual funds. And the reason you do that is because by their very nature, they contain many different types of investments. And so to my mind, a properly diversified investment portfolio should contain money market instruments, should contain bonds, should contain equities, and perhaps some mutual funds. Now, the quantity of those assets in your portfolio will really depend on how risky you want your investment portfolio to be, right? And Tutu, I don't know if you have anything to add.
Thank you, Laura. I think you've said it quite well in terms of the importance of diversification. To just add 2 or 3 points to what you've mentioned, what I would say is, in addition to diversifying your portfolio through an allocation to different asset classes, our viewers should also consider diversifying their portfolio from a currency and geographical perspective. And really, why do I say that? So for example, with inflation at 17% at the moment, the question you most likely ask yourself is your portfolio really well diversified, especially if you have liabilities in hard currencies? It might be important for you to actually look at your portfolio to see whether you're diversified from a currency perspective. In addition to that, another thing I want to add is I know that globalization has sort of harmonized the way we have different markets. But what we also know is that all those markets are not perfectly correlated. So if you look at what's happening in the developed, emerging, and frontier markets, they are not perfectly correlated. So there is some benefit in also diversifying your portfolio from that perspective. And I think to finally close, another thing I wanted to mention really is avoid positive correlation between your human and financial capital. And what do I really mean by that? So your human capital is really what you earn from your everyday job, while your financial capital actually grows as you save and invest. So the more you save and invest, the more your financial capital grows. So take, for example, the COVID pandemic. If you were someone, for example, that worked in the aviation or hospitality sector, I think most of us understand that that particular sector suffered during the pandemic. I mean, 65% of revenues of the airlines actually plunged in 2020. So what could have happened in that case is, assuming the revenue actually went down in that particular sector, and you also lost your job in that particular sector, it will have had a situation whereby the client will have lost money in both ways. Another way to look at it, for example, is a situation whereby, if you remember the banking crisis we had, where, for example, let's assume you used to work for, not for any particular reason, maybe Oceanic or Intercontinental Bank. If you had a stock portfolio that had a lot of concentration in that particular stock and you also lost your job, it will have been a double whammy for that investor. And I guess to just close out on a very light note, another thing I would ask really is, how diversified is your household? Husband and wife, are you exposed to the same sector? Are you also volatile to uncertainties associated with that sector? Do you guys both work in the banking sector? So if something happened there, how would you guys manage your finances? So it's really just trying to tie everything by saying, don't only look at it from the financial asset perspective, look at the currency, look at the geography, and look at your human and financial capital. Yeah, I think that's about it. Thank you, Laura.
Excellent, excellent. Thank you both for those very, very in-depth answers there on how one would describe a well-diversified, balanced investment and why it's important to have one. Interesting poll results. 48% of our participants say that they're diversified. It gets interesting. 30% say they are somewhat diversified, and 22% say diverse what? So if you consider that, that's 52% of our participants are either somewhat diversified or really are not at all. So a healthy 52%, majority of people listening in definitely are taking notes with respect to the answers that Laura and Tutu just gave us. All right, Tutu, let me come to you now. What are the factors to consider when choosing types of products to invest in?
Okay, thank you for that question. For me, really, a good starting point is really deciding what your objective is. For you to decide on what product, a good starting point is to determine what you're really trying to achieve. Take, for example, at the end of the year, most people do some self-retrospection in trying to really understand what they're worth from a financial standpoint. So let's assume I'm currently worth, or what I do is I'm currently worth maybe 10,000 naira, and at the end of the year, I want to be worth 11,000. So I think that is a good starting point to decide what sort of products you want to invest in. So, for example, I need to get to 10,000 to 11,000. What do I need to do to get there? What sort of product do I need to be investing in? And I think that is a fantastic starting point. So take, for example, as well, if your objective is really to pay rent at the end of the month, an example would be to invest in our FBA money market fund, which ensures that you're able to meet that particular objective at the end of the period. And why is that? That is because that particular fund ensures capital preservation and provides liquidity that ensures that by the time you want to pay your rent, that money is available to you. Knowing fully well, for example, as well, that the money market fund actually pays better than your savings account. It's a no-brainer for you to actually put that money in a money market fund. So now that we've established that you know what your objective is, the other thing is how do you get from point A to point B? It's also trying to determine what you're willing to do to get there. And that takes me to the point around how much risk you're willing to tolerate to get to where you want to go. So you really need to understand your risk tolerance level. Now, another thing to consider really would be your unique requirements. So take, for example, we have our Muslim brothers and sisters that could be on this call. They would definitely not invest in any product that is not Sharia compliant. So those are the things they also look out for when they're trying to invest. Other things will include what's your liquidity need, your time horizon, how long are you willing to lock that money for before you invest. Now, I know I'm going to go through quite a lot of things to tick off because it's quite important. So we've determined what our objective is. We know how much risk we're willing to take to get there. We know our unique requirements. The next thing has to do with us evaluating the different alternatives we have in the market. So what you're trying to do now is to find which product to put your funds in. And I think a good starting point is also understanding the underlying asset backing this product. So you have different advertisements around different products in the market. I think the question you should ask yourself as an investor is, what is the underlying asset backing these products? Are they government securities? In that sense, you ensure that your capital is preserved to some extent. Really, those are the questions you should ask. Are they credible institutions? What are the ratings of the assets that they have in that particular portfolio? So once you've done that for me, I think the next thing to do as well is look at the historical performance of this product. What is the track record? How long has this product been around? Ask those questions. Do you have access to fact sheets that give you information about this product? Once you've ticked that off again, sorry, I'm going down the line, is also the brand. How transparent are the brand you're trying to invest in? And once you've understood that they've been around for a while, they are quite transparent, you have access to information and performance about the fund, and I guess you've ticked that box. And to close out, really, I think the last thing I would like to emphasize is that people see bold numbers in red, 12%, 20, 25, and they really get excited. But I think what people should also try and understand is try to look for those little fine prints at the end of whatever product you're trying to buy. Look at things, are they gross or net of fees? How long is your money going to be locked up for? So you really need to understand the future. So I would say, finally, just read the fine print to ensure that you really understand what you're getting into. And to close off again, I'm still going to say that again, is taking ownership of your financial independence. So once you've determined your risk tolerance, your objective, you found the product, you know that they are transparent, don't just invest and leave it. You need to also take ownership of monitoring how your investment is doing. And I think that's about it. Sorry, I went all the way on that, but it's a really long checklist. Thank you.
It is. And you went in depth there. To Laura, please, you want to add to that?
No, Tito, honestly, your answer was fantastic. It was, and I think that it is so important as investors to really understand yourself. You know, you find that investing is really almost about understanding who you are and what it is that you can accept, or the kind of journey you want to create for yourself. And so it's so important to understand your own personal objectives for investing, your personal circumstances, your time horizon. Tutu mentioned your religion, for example. Do you only require Sharia compliant investments? How risky do you want your portfolio to be? You need to understand the risk of the investment and also your own personal risk tolerance so that you're able to withstand the investment journey, right? So you've chosen to invest in equities, for example, you understand your own risk tolerance so that, you know, when equities are sort of moving up and down, you are not fretting, you're not making decisions on the fly because you didn't really understand what you were getting into. So, I mean, she spoke. Excellent answer.
Great stuff. See, that's why they call it leading conversations with FBN Quest because the answers are in-depth, illustrative, and convey so much understanding. Thank you both for that. We have another poll. Because we want to start talking about risk threshold. So for our viewers, our participants, here's the second poll question. What is your investment risk threshold? Are you low risk? That's option A. Are you medium risk in the middle, or are you higher risk? You like to live on the edge when it comes to your investments. So do respond to that. And also, we got a Q&A box at the bottom, because remember, we're going to be taking your questions and asking our participants, our guest analysts. So there's a Q&A box at the bottom. I already seen a couple questions already. So our participants are already asking questions, but we got a question for you. So again, what is your investment risk threshold? Low risk, medium risk, high risk? All right, Laura, let me come back to you. As an investor with a moderate, I think that's the second option on the poll, the medium risk threshold, an investor with a moderate risk appetite, what splits would you advise across investment options, Laura?
Okay, thank you for that, Rutus. Now, in terms of moderate risk appetite, for me, the very first thing it means is that you as an investor are willing and able to take risk. So that means that, first of all, you're willing to take on some losses in order to make gains. I talked earlier about understanding who you are and you know, your own personal risk tolerance. So that's the very first thing that moderate risk tells me. Now, as I mentioned earlier, it's important to ensure that when you're investing across a variety of asset classes to properly manage your portfolio's risk. So with that in mind, for me, a moderate risk investor would have to have a mix of, say, money market instruments, bonds, equities in their portfolio. But Tutu also mentioned a very, very important point when she was answering earlier. She spoke about investing across geographies and currencies as an important aspect of diversification. And I think that that's also very important. Now, there are many factors you consider when deciding how to split your portfolio, so how much of each asset you should hold. But a moderate investor, to my mind, probably has a portfolio that is equally split, perhaps across those main asset classes. And then if I assume that this investor is trying to build a portfolio, you know, for the long term, right, then I can say that you probably won't have a portfolio that's split across bonds, equities, and money market instruments. Now, if I think about the practical way of doing that, for example, I think of our FBN Balance Fund, which actually follows a moderate risk investment strategy, and it's invested across money market instruments, bonds, and equities, right? So it really is the sort of investment that a moderate risk investor would be looking at. That fund last year, because of the low yields in fixed income markets, because of the strong equity market performance, it actually returned 27.8% in 2020. So it just speaks to how potentially profitable and exciting a moderate risk investment strategy can be for an investor. Now, for me, the other point to note is that factors like, you know, your age, your time horizon, etc., would definitely affect the kind of investments you buy. If an investor is moderate risk, but they need their money within 6 months, and that's possible because your risk tolerance is not necessarily tied to your time horizon, right? So if you're a moderate risk investor, but you actually need an investment that would be ready for you to use in 6 months because of your lifestyle or whatever it is that, you know, you're trying to use for that, you use that money for, I wouldn't advise such an investor to buy long-term assets like equities, for example. So I mean, that's something to bear in mind. As I mentioned earlier as well, equally important, currencies, geographies are also good, also things to consider, really whatever your risk tolerance. Trish, I don't know if you wanted to add anything.
I think, Laura, you said it all. I really don't have anything to add. Thank you.
All right. So Tutu, I'm going to come to you now. Laura, thank you so much for that. And in fact, looking at our poll results, it looks like a majority of our participants in this webinar, again, leading conversations with FBN Quest, looks like they're in the middle of the road. They're medium risk. So poll results so far, again, our question, if you still haven't voted, go ahead and vote. But What is your investment risk threshold? 29% are low risk. Majority, 56%, are medium risk. And my type of people, 15%, high risk. They like to live on the edge. So we're coming to the high risk people right now. Tutu, this is for you. For the 15% of those that voted and said they're high risk, what split would you advise across investment options for the high rollers, the high risk takers?
Okay, thank you for that question. I think we can start by saying really, who are those investors with high risk appetite? Generally, you classify young individuals as those with high risk appetite just because they have a longer time horizon to sort of recover from any possible losses from investing in these risky assets. But really, that's not always the case, like you say it. I'd just like to advise investors on this webinar to really try and understand what their risk appetite is. You might have classified it as low, medium, or high, but there are actually risk profiling calculators out there that can help you really see where you're falling. Although it has to do with willingness and ability, but to some extent, you can see where you're falling within that ladder. So coming back to your question around those investors that are risk takers and have a very high risk appetite, I'll really classify them as aggressive investors. And for me, someone that is really, really willing to tolerate more risk than the profile Laura described earlier, which is you're willing to take an extra level of risk just to earn a higher level of return. So they're able to accommodate more volatility in their portfolio than anybody else. And I would just liken them to an investor that's willing to just throw in all the cats and see how much money they can actually make. So to really answer your question around what should be the appropriate allocation, for me, I guess it would be a significant portion of your portfolio being allocated to risky assets just so that you can earn some potential higher return. It's really not guaranteed that you're taking more risks, that you're definitely going to earn a higher return. So an example of those risky assets will include equities, which is what we're used to, but we have more exotic options there like derivatives, foreign exchange, cryptocurrencies, commodities. I would even say investing in a new business is also quite a risky investment. And for someone like me, for example, investing in Bitcoin is something I classify as really high risk because it depends on what Elon Musk wakes up and says the next day, whether it's going up or going down. So really, I guess it just has to do with how volatile that particular asset class is. An example of that will most likely be an 80% allocation to our FBN Smart Beta Equity Fund, which is a core equity fund that we have in-house. That particular funding is high as 16% last year. So an 80% allocation, for example, to our Smart Beta Equity Fund and 20% to our money market fund will most likely qualify for that kind of portfolio, looking for a high risk appetite portfolio. But having said that, another thing I wanted to mention is it really worth it? When you look at risk adjusted return on taking so much risk, does it really compensate? An example will most likely be what the NSE did last year. I think the NSE 30 did about 39.3% last year. And I guess if you're an investor that really puts a lot of your investment in on the NSE, you'll have made a lot of money. But flip it the other way as well. It also lost 18.9% in 2019. So I think the question is you really need to understand what your risk tolerance level is and willing to accommodate the volatility associated with that particular portfolio. So I think 80-20 is a good way to go in terms of allocation, but a significant portion is quite key in determining that your portfolio is exposed to high risky assets. And that'll be it for me. Thank you.
Thanks, Tutu. Laura, did you want to add anything to that?
I think for me, the only thing I would add is that many times I find that the riskiness of an investment, sometimes it's not explicit. And so it's important to understand what you're investing in so as to determine its true risk level. So I often find that the return that's promised and whatever form that return is promising. So even if you're told you're going to earn 20% in 6 months, for example, in this investment, for me, that gives an indication as to its risk level. Because if you have to offer investors 20% to attract money to your investment, when interest rates are at, let's say, 5 or 6%, that means that the underlying investment is risky. And so it's important to understand that as well, because sometimes when investments are couched as fixed return, almost, sort of capital guaranteed investments, and the returns are very high, investors get seduced, by that, and they sometimes forget to do their due diligence or to really appreciate that what they're investing in is a high risk investment. So if you find yourself participating in some of these more exotic options, whether agri, Bitcoin, and co, and you find very high promised returns, it usually tells me that it's a high risk investment. And it's just something to be cognizant of as you're investing.
Great stuff. Thank you so much for that, Laura. And again, also Tutu as well. Once again, we're still continuing the conversation here on portfolio diversification, leading conversations with FBN Quest. Okay, Laura, let me ask you this. How can an investor determine if she or he is well diversified?
Thanks, Rutus. Okay, so first of all, I think I'll just put it out there and say this is really not an easy question. There's almost no calculator or something that you go to tell you if you're properly diversified. A few thoughts come to mind. So for me, the first thing is, I'd ask you to ask yourself, how many asset classes are you invested in? Is your portfolio spread across various asset classes, so bonds, equities, and so on? Is it spread across various currencies? So are you invested in Naira and say US dollar and something like that? So that's one area. The other thing I would ask investors to do is to look even within those asset classes and ensure that as much as possible, you're not just holding a single asset. So for example, your bond portfolio should not just contain a single bond. Finally, and I think most importantly, what you want to be checking is that the securities in your portfolio behave differently, right? And don't move in the same direction all the time. I think that's really what we talk about when we say diversify. It's really not just about holding many instruments, but it's about holding instruments that don't move in the same direction all the time. Tutu mentioned not having assets that are positively correlated to each other when she was answering questions earlier. And really that's what we talk about when we say you need to diversify. As I mentioned earlier, mutual funds, perhaps even exchange traded funds, ETFs, are good ways to achieve diversification cheaply because in themselves they're already diversified. And so that's one way to ensure that you are diversified. And I bring this up because you sometimes find that the amount of money an investor has can make it hard for them to, say, for example, buy enough bonds to make their bond portfolio diversified because they really don't have the capital to buy multiple bonds, because in the bond market, they tell you that you need to buy in lots of 100 million face value or 50 million. And so if you don't have that amount of money, it then becomes hard to buy 4 or 5 bonds to ensure that you're holding a portfolio that's spread out, that's not exposed to a single bond. And so you find that maybe using mutual funds is a good way to achieve diversification even when you don't have a large capital base or a lot of money to make up your portfolio. Tutu, I actually think this might be a good time to talk through how often an investor should also be reviewing his or her portfolio to check that it's still well balanced. I think it's a nice time to go into that.
Okay, so to that question, it just brings me to the point I made earlier around investors taking some level of ownership of their own financial independence and portfolio, especially for those that cannot really afford a bespoke portfolio that caters to their unique requirements. So we've spoken during this webinar about you doing your homework. You know what your objective is, your risk tolerance is, you made a decision of which house you want to invest in. Once you've done that, you don't just stop. You need to make sure you continuously reevaluate that portfolio on a timely basis. Why? Because a wise holding today might not necessarily be a wise holding in the future. So this brings you to your question, how regular should you rebalance your portfolio to see that it's well diversified? And for me, I think one trigger I would say is a change in personal circumstances is when you might need to evaluate your portfolio. So take, for example, let's assume someone was involved in an accident and maybe lost their job. That would call for a revaluation of that person's portfolio to see whether the risk tolerance level is more than what that person can accommodate. Another instance could be someone who just lost their job or just changed their job. Say, for example, moved from a tech space to a banking space. That would mean that the person is now earning income from the banking space. And to that end, is also exposed to the volatility associated with that sector. To that end, that might be a good time to also look at the portfolio to see that the stocks in that particular portfolio are not concentrated in banking stocks. Another example could be maybe a change in interest rates environment. So before now, I think we're all happy around earning interest rates around 18, 19, 20%. Everybody was fine. But now the tables have turned. We're now, although rates are reverting from where we saw them in 2020, rates are now at negative rates of return. Inflation is at 17. The 1 year treasury bill is about 7%. So you're earning negative real rates of return. And what most people are doing now is actively looking for other products where they can enhance their portfolio. And you have dollar assets, for example, even giving higher than what you're getting on some Naira assets. So that's also a good time for you to just reevaluate your portfolio to see whether it's really well diversified. Another thing could be a change in your objective. Maybe you wanted to grow your fund just on the short-term basis and decided to change that to a long-term perspective. So for me, I think in terms of rebalancing your portfolio, checking to see how it's well diversified is something I feel is continuous. Having said that, some people tend to benchmark that on a 6-month basis, which I think is quite relative. But I think what stands out for me is when your personal circumstances do change, or you notice a significant change in the markets, then that might be a good time for you to reevaluate your portfolio. Yeah, I think that's what I'll add to that, Laura. Thanks.
Thank you both. Thank you both. Remember, folks, for our participants, leading conversations with FBN Quest. We've got Laura, we've got Tutu answering questions, but do add your questions to the Q&A box at the bottom of the screen. We have one more poll coming up. Not quite yet, still have another question for our analysts. Laura, I'm going to come back to you. I want to talk about asset classes now. We're getting, even further into this conversation. What asset classes, Laura, are more suited to long-term investors, and what asset classes are more suited to short to mid-term investors who may need to access their funds with a considerably shorter time than long-term investors?
Okay, thank you. To my mind, generally, short-term investors, and for me, when I'm thinking of short-term, I'm thinking investors who require their money in 1 year or less. Short-term investors should ideally focus their efforts on money market instruments. And to my mind, the reason for this, like I said, these are instruments that have natural maturity dates of 1 year or less. So what that means is that in 1 year or less, you will have your money back because your investment will have matured. Within the money market space, there are various asset classes. We have treasury bills, we have commercial papers, which are short-term debts issued by companies. We have fixed deposits, which are the usual bank placements that we all do. So it's possible to still be diversified within the asset class. But what it really means is that you are aligning your investment strategy, your investment assets with your personal time horizon, which is extremely important. Tutu had mentioned earlier, if you wanted to save for your rent, for example, the last thing you want when you want to save for your rent is buying a, say, 5-year investment. And then in 1 year's time, when you need the money for your rent, you're not able to raise the money quickly, or you're able to raise the money, but then they tell you that the price at which you are selling is lower than the price at which you bought. So there are all those things that you want to avoid when you are saving money for a very short time. We had spoken earlier around using mutual funds as a way to achieve diversification and still remain within your goal in terms of a short-term investment. Tutu had introduced, I think, the FBN Money Market Fund. She spoke about that earlier. And for me, that's a good example of a diversified investment vehicle that investors can use if they want a low-risk short-term investment. Because with that fund, it really means that with as little as 5,000 Naira, you can be diversified. And the reason that you are diversified is because you're investing in a portfolio that, because of the monies put in by other investors alongside you, the portfolio itself holds various assets and in itself is already diversified. And it still meets the short-term time horizon requirement that you have as an investor. Now, for investors looking to invest for a longer term horizon, that's where you can expand yourself and begin to look at other asset classes like equities, like bonds. You can choose, like entrepreneurship, all the other things really that we all want to do with our money. Many times it falls into the longer term horizon. Now, if I take bonds, for example, bonds are an excellent long-term investment. They have a fixed coupon that they pay to investors periodically. So that really helps in terms of getting an income out of your investment. But naturally, like I mentioned, because their maturity dates are 1 year and above, it really means that it is perfect for an investor looking for something that is longer term. Of course, because these are instruments that trade in the market, especially for the FGM bonds, it might mean that when you're buying it, you're not buying it at the price that it should. Maybe you're buying it at a higher or even a lower price. I mean, you're buying it at the current market price. But whatever it is, the point is that their maturity dates are greater than 1 year. And so it really is a perfect long-term investment. Another one that comes to mind, are equities. Now, equities are an ownership stake in companies. What it really means is that you are buying into the company and to be part of the company's journey. It means that you as an investor will be able to enjoy the company's profits, and you enjoy that by way of dividend payments or even the increase in their share price. Also means that you suffer in their losses as well. Now, equities don't have a maturity date, and it's because you are investing in an ongoing business. So similar to being an entrepreneur, you have to give it some time to yield its gains. It may not give you the returns you're looking for in 3 months or in 6 months. You may have to give it some time to see its gains. But I mean, the only time an equity will end theoretically is either the company goes under, or the company is taken over. So essentially, they don't really have a maturity date as such. Now, as an investor, it's important to be well positioned. I've spoken about the FBN Money Market Fund, but in fact, across asset classes, we have various funds and investment options that can help investors, say, invest in bonds, for example. So using the FBN Bond Fund, can invest in equities. Tutu mentioned earlier the FBN Smart Beta Equity Fund. I mentioned the Balance Fund before when I was talking about investing across various asset classes. In fact, for investors looking for dollar investments, and this speaks to the point we talked about earlier about investing in diversifying across currencies, the FBN Eurobond Fund can be very, very helpful. In fact, it's a fund that we're quite proud of, because what it has done is it has offered investors really fantastic returns in dollars since we started the fund. Last year, for example, investors earned over 7% in dollars using this fund. So it can be very, very useful for investors looking to invest in dollars. Other investment options, I think, for longer term, investments in commodities. So for example, owning a farm, to my mind, is a long-term investment. Entrepreneurship, buying property, these are all things that I believe are long-term investments. And when you move into this space, I think that your skill set also comes into play, right? So for example, owning a farm or being an entrepreneur, the success or failure of that endeavor will rest quite a bit, not just on how much time you're willing to, whether it's a long-term or short-term investment, but also on your personal skill set as well. But there are a variety of things that investors can do when they want to invest for the long term. It really is just about understanding yourself and what it is you're trying to achieve. Thanks, Reuters.
Thank you so much, Laura. Tutu, did you want anything to that?
No,
answer?
I don't think I can top that. Thank you.
All right, we got one more poll. We have one more poll because I'm coming to Tutu with another question about I guess the investment journey and engaging professionals. So the poll is up there for our participants. So kindly vote in this poll. Do you need the services of a professional to help you diversify your portfolio? Yes, no, undecided. I'm speaking for myself. Yes, I need a professional. I'll tell you right now. That's my vote. I'm voting yes. But do vote there. Do you need the services of a professional to help you diversify your portfolio? Yes, no, undecided. We're continuing, of course, leading conversations with FBN Quest. We've got Laura, we've got Tutu. So Tutu, I'm coming to you now. At what point, Tutu, in one's investment journey, does someone need to work with a professional? Is it from the onset or after you've built a sizable portfolio, Tutu?
Okay, thank you for that question. The answer is immediately. Immediately. There is nothing grand for me or really magical about building your wealth. To me, it's really achieved through the culmination of small, disciplined and deliberate choices that we make in the course of our investment journey. It's never too early to begin from my perspective. I mean, I'll say, in fact, the earlier the better. So I guess to answer your question, you should start utilizing professionals from the onset. And like we've mentioned throughout this presentation, mutual funds provide access to such professionals, especially because there are little or no barriers to entry. For example, take our FBM money market fund, like Laura mentioned, with as little as 5,000 naira. You gain exposure to a diversified basket of investments with credible institutions managed by the same seasoned professional manager that somebody else that brought in 100 million would also gain access to. So it's not really about the size. I think the important thing is really starting today. And another thing I'd just like to mention is, why don't you allow the professionals focus on maximizing your wealth? The truth is that it's our core and area of specialization. While you focus on, in my view, an investment that generates the highest return, which is an investment in yourself. So let us be the one bothering about maximizing your financial capital. You focus on building your human capital. And I guess to really close up, I'll just say that it's quite important that you're very deliberate and disciplined about your finance. I mean, we mentioned the importance of getting on with a professional very earlier in your investment journey. But having said that, I think selecting a credible partner is also quite important. At FBN Quest, if I must say, we're ready to support you on your investment journey through the various solutions that we offer in-house. We spoke about maximizing your wealth. We spoke about trying to achieve a particular objective, diversifying across different currencies or different borders. At FBN Quest, we're ready to take that journey with you. Our heritage, our track record of performance, which I must brag about, high level of transparency, seasoned professional managers and solutions that are there to sort of get you to that objective that you're willing to, so that goal you're willing to achieve. So what I'll just say to close off is select your partners wisely, and FBN Quest is here to partner with you on that journey. Thank you so much.
Thank you for that, Tutu. Thank you for that. And well, you know, accurate answer, because 72%, the overwhelming majority of the respondents to the poll say yes, that they need the services of a professional. The minimum, the minority, the 18% said no. 22% are undecided. So I'm going to shift those 22% over to the majority, over the 72% that said yes. So because if they're not sure, that means they're probably leaning towards the fact that they do need an investment professional. So well said, Tutu. Well said, Laura, as well. All right, so that brings us to the, I guess, the end of my questions. Now is the Q&A. So please remember, folks, the box at the bottom of the screen, throw in your questions. We got a lot. So this happened the last time I was on this. We did this webinar together. There were quite a number of questions. All right. Laura, I'm going to throw this first question at you from one of our participants. Laura, with inflation running at greater than 15%, what type of fixed interest securities, I think it's fixed income securities, can currently provide a domestic investor with real returns? Laura.
Thank you, Otis. So inflation, I mean, he said it all. Inflation is running at 17+%, and food inflation especially is running at 20+%. So clearly, Tutu had alluded to the fact that we're in an environment where we have negative real returns, because the returns of most investment assets nowhere match inflation. To be honest, because risk-free, so government assets, when you look at their yields today, they're running well below 15. So even if you're looking at long-term bonds, the yields are at about 11 or 12%, certainly much lower than where inflation is. To get returns above 15, 16, 17%, you would really have to be looking at high-risk investments. You'd really have to be looking at, I've seen, a few investment opportunities that come through where the returns are 16, 17, 18%. And the reason for that is that the underlying investment, the underlying company being invested, the underlying opportunity itself is in and of itself quite risky. And so whilst it is structured that you will get your money back at the end of the 10 or let's say 1 year or whatever, you may not get that money back. And that's the reason why the investment is 15 or so percent. So to my mind, things to invest in that are, and the reason why I'm saying is because you asked for fixed interest investments. The other thing I would have spoken about, if you hadn't mentioned that, would have been to say other asset classes can provide these high returns. But of course, it then becomes difficult to structure as a fixed return investment. So by the time you move into things like, real estate, commodities, all of these areas, you then find returns that are much higher when you move into even investing in small type businesses, or providing some kind of financing to smaller businesses. You're able to get returns that are higher, but the other side of it is that the risk of it is also high.
Thank you for that, Laura. So there's your answer to one of our participants. More questions coming. Okay, Tutu, this one's for you. Earlier, Tutu, you talked about investing across geographies. So Anthony Johnson sends in a question saying, can you please expatiate and give examples of what you mean by investing across geographies, Tutu?
Okay, thank you for that question. What I was trying to say is, so for example, if you evaluate your current portfolio, your asset allocation, and you find out that all the investments you have, for example, are within the Nigerian jurisdiction, it means you're concentrated and you have Nigeria specific risk. So for you to get out of that bucket, an interesting thing to do is to maybe move outside of Nigeria, for example. So we're even planning to, okay, I shouldn't say this on this call. So if you're planning to invest in other markets, for example, you can invest, for example, in assets outside of Nigeria. You could do some investments in other African countries. It could be Africa, it could be Egypt, it could be Ghana. You could also invest in some of the assets outside of the African or emerging frontier markets by doing some in actually US equities or US treasuries. So by that, you're not really exposed to Nigeria specific risks, for example. Now that you're seeing that the Naira is currently devaluing, the value of the Naira keeps depreciating, because you have exposure to another market that's not positively correlated with the Naira, you benefit from that diversification in the sense that when you look at the real value of your investment, whether in another currency, you're better off than just having it fixated in a particular geography. That was what I was alluding to. And like we mentioned, it might be very hard for an investor that really has a small portfolio size, which is why mutual funds help you to achieve this particular objective. So really, that's the answer to that question. So partnering with a professional is quite key to achieve that objective if you don't have a large portfolio size.
Great stuff, Tutu. I noticed Tutu was about to spill some beans. I don't know, FBN Quest is working on a lot of stuff. So you guys should follow them. Maybe whatever she was about to spill, they'll announce it on their social media platforms sometime in the future. So at FBN Quest. So keep your eyes on them. Who knows what beans they might spill with regards to giving you guys great returns. FBN Quest across Twitter, Instagram, and so on. All right. Thank you again, Tutu. Laura, I'm going to come back to you. You got another question. I hope we're able to get through all these questions. There's so many. Laura, is your invested capital preserved when you're invested in FBN's money market fund?
Thanks, Roses. Yes, it is. Yes, it is. In fact, the FBN Money Market Fund was created specifically to help investors who want to have that capital preservation, who want to earn an income, who want to be exposed to only money market, low risk investments. You can almost think of it as an alternative savings type of platform. That's really what it was created for, to be an investment that you can come into and go out of, still earn a competitive return, and feel comfortable that your capital is safe. So that was a very easy one. Thank you for that.
Great stuff. Thank you, Laura. Tutu, this is a similar question for you. Will capital be preserved with the FBN bond fund? That's same question for you. Well, same question, but different investment option, because FBN Quest, you guys seem to have a lot of investment options. So that question is for you, Tutu.
Yes, definitely. Your capital is also preserved when you invest in the FBN bond fund. The difference between the FBN money market fund and the bond fund is really the assets underlying that particular product, which we've mentioned throughout this presentation. So your capital is also preserved. At the moment, you can earn as high as 5.48% in terms of the yield to maturity on the bond fund. So your capital is preserved in the bond fund as well.
All right. Thank you for that, Tutu. Okay, Laura, back to you. Another one. This is from Tunde Adewoye. Is there any mutual fund with FBN Quest that incorporates investments in real estate? That's from Tunde.
Thanks. Real estate, it's such an interesting and to my mind, it's a very exciting asset class. It's something that we're working on. We don't have any funds currently that invest in the real estate space, but we are looking at it. And are looking to create something, that, because it's, for me, especially when we think about the fact that treasury bill yields are very low, bond yields are not exciting. Equity markets, it's touch and go. Tutu mentioned the NSE 30 was up 39% last year, but in the prior year was down 18%. So, with equities, you can have a very volatile, very, heart-wrenching journey sometimes. So, it's an area that we're looking at, and we're hoping that we can really put something together that we can bring to market shortly.
Thank you so much for that, Laura. Okay, Tutu. Okay, this is an interesting one because earlier when I asked you both about, investment splits for moderate risk appetites, I think also Laura. Then I asked Tutu about investment splits for high risk. I didn't ask about low risk, although our poll did cover that. We asked a lot of people out there, and most of them were medium risk, but some were low risk. So Tutu, this is from one of the participants in this webinar. Again, leading conversations with FBN Quest with Laura and Tutu. Tutu, what is your best advice for someone with a very low risk appetite? So this person is ultra careful about their money. What's your advice to that person?
Okay, my advice to the person is really to stick to investments that have a very low risk profile. At the same time, there is really no free lunch anymore. If you really have a low risk appetite, then you can be looking for aggressive returns. So in terms of products that we offer in-house, the FBN Money Market Fund is a suitable fund for that particular investor. The FBN Bond Fund is also suitable for that particular investor, but haven't mentioned during this webinar that is really understand your unique requirements. So how long is the person willing to leave the money locked up for? What are the liquidity requirements they have in terms of obligations 2, 3, 4, 5 months down the line? And understanding of that to be able to profile the allocation across this sort of safe investments. So in terms of assets that they can actually invest in, or the mutual funds that we offer, solutions we offer in-house, I'll most likely recommend the FBN Money Market Fund and the FBN Bond Fund. And also, if the person actually has some dollars in their maybe domiciliary accounts, which is really not any much for them at the moment, the client can also put some of that money in the FBN Eurobond Fund, which is also preserves your capital to some extent, as long as the issuers don't default. But we haven't had a case of any default in Nigeria. So I would say the FBN Money Market Fund, the Bond Fund is appropriate. And at the same time, the FBN Eurobond Fund is also appropriate, just to diversify the person's portfolio from a currency perspective. Yeah, that would be my recommendation. But it would be nice to speak to the person and get an understanding of what their true objective is.
Great. It's great. Thank you for that, Tutu. Thank you also, Laura. So yes, speaking of talking directly to folks, you all are encouraged to send emails because there's so many more questions and we're running out of time. But webinars@fbnquest.com. You do send an email. Also follow FBN Quest on their social media handles @FBN Quest, Twitter, Instagram. Drop your questions. Look at Tutu's already asking to speak with whoever that was that has sent that question. So she's profiling you already. Laura was also talking about interacting with you all. So be sure to send those questions to webinars@fbnquest.com. That, ladies, okay, you know what? I just, let me squeeze in just one question here. Tutu and Laura, you guys can take this, so whoever wants to go first. Is it important for investors to be patient with returns? I think we can end it there. Laura, what do you think? Should investors, is it important for investors to be patient with expectations on returns?
I think so. I find that, especially because we're investing in Nigeria, so it's a very volatile market, right? Sometimes the very high returns, I think, can mask just how much volatility there is in the Nigerian market. But it's a very volatile market, and so with that, I think it's so important for investors to be patient. I mentioned earlier the importance of understanding yourself, understanding your objective, and then understanding, instruments that are available. So for example, if you're a very low risk investor, you really don't want any volatility, you don't want any stories on your capital, for example, it then really means that you're investing in money market instruments. And then if you're investing in only money market instruments, the low risk side of things, it can then mean that you are really just needing to be patient and invest based on what's in the market today, which might mean that returns will be low. So I think that as an investor, you have to be patient. You have to be patient. You know, nothing good comes overnight. You have to be patient.
Tutu, would you like to add to that?
Nothing much to add. I'll just say stay the course, baby steps, little by little, discipline and deliberate choices, and that will get you to getting your objective met, regardless of whatever it is. Anytime you find returns that are too good to be true, especially if they don't align with the current market realities, just don't rush into anything. We've mentioned this throughout this webinar. Try and read the fine print, understand the brand. Is it really transparent? The track record, their reputation. It's quite important that you tick all those boxes. And then slowly you get to where you need to get to. That's what I really have to add. Stay the course, deliberate, and be very disciplined. That's how I'll close it out. Thank you.
Fantastic stuff. We close it there, ladies and gentlemen. I wish we could go on for another few hours because there's so many more questions, but please forward all your questions again to webinars@fbnquest.com. In fact, we just in the chat room, a little chat box there, we've actually put a phone number and email for you to also contact FBN Quest. Also remember at FBN Quest on social media handles in order to find out, ask questions about the investment options that are there. My thanks to Laura Afisaya Kolawole and Tutu Olabi Kadiku for, of course, engaging us, answering all these questions in depth and providing all this advice when it comes to investment, and also sharing the wealth of investment options that FBN Quest has available for all our participants out there. So you folks do reach out to FBN Quest again at FBN Quest and also at that email webinars@fbnquest.com. Thank you all. I am once again Rosus Odiri, host of the Global Business Report on Arise TV and Business Express on Smooth 98.1 FM. Keep in touch with FBN Quest on their social media handles because this is going to continue. These conversations are going to continue. So again, thank you all so much for participating, sending in all your questions, and FBN Quest leading conversations with FBN Quest webinar will continue again. Let you know when the next one is. Tutu, Laura, thank you guys so much. It's been a pleasure.
Thank you for having us. Thank you everyone for joining.
Thank you so much. Thank you. Bye-bye.
Bye-bye.